This video is to cover journal entries for fund-based accounting statements. Prepare these entries for the journal fund to record the following transaction. Just checking that the recording is working. So, number one, estimated revenues for the fiscal year were $250,000, appropriations for $248,000. So we're in the general fund. And we are going to debit estimated revenues to create a budget. Numbers, make them look pretty. So estimated revenues were $250,000. Appropriations or expenditures were $248,000, and the difference between these two accounts is fund balance unassigned. And that's $2,000. So that's the amount of the fund balance that has not been assigned. Number two, the tax levy. Let me just fix this so I can label it. Insert. Number one. Alright. Number two, the tax levy for the fiscal year, of which 99% is believed to be collectible, was $200,000. Again, we're in the general fund. And it's going to be taxes receivable, current, $200,000 for the entire levy, allowance for uncollectible taxes, and that is 1% for $2,000. And then we're also going to debit revenues taxes and that's 99% or $198,000. Now, a short-term loan of $15,000, taxes were collected. Taxes collected were $150,000. So for the year, taxes collected were $150,000. We're in the general fund. If we collected them, we're going to have taken the cash of $150,000. And then we're going to reduce the taxes receivable, current, by $150,000. Okay. Number four, a short-term loan of $15,000 was made to the Special Revenue Fund. So, number four. The general fund is going to make a loan to the Special Revenue Fund. So we're in the general fund. Should I read this quickly? So, other, it's a loan, so we use due from Special Revenue Fund. That is because they're going to pay us back $15,000. And then cash, $15,000. And we're also going to be in the Special Revenue Fund. And in there, we would receive the cash, and it would be due to general fund. Alright, now the next one. Ordered supplies were placed in the amount of $18,000. So we're going to order supplies in the amount of $18,000. We're going to be in the general fund. And when we order something, we're going to create an encumbrance. Encumbrances, 18,000. Reserved or encumbrances, 18,000. The items ordered in transaction 5 were received at actual cost of $18,150. Vouchers for that amount were prepared. Okay. So number 6, we're in the general fund. So if we made an encumbrance when we ordered it, we must reverse the encumbrance for the same amount that we made it in. For encumbrances, and the amount that we made that for in number 5 was 18,000, and then encumbrances, 18,000. And now we'll also recognize the supplies, and it's expenditures, supplies, 18150, and vouchers payable. I'd like to think of that as accounts payable, so it's a current liability. Alright, so moving on to number 7. And number 7 from 211 is materials were acquired from the store's funds, an internal service fund, in the amount of $800 without an encumbrance. So, in the general fund, and it's going to be expenditures, 800 due to stores, due to stores fund, 800. Alright, number 8, a $5,000 transfer payment was made to the debt service fund. Transfer out debt service fund, cash, right there. And then if we're recording this in the debt service fund, we would receive the cash, other financing sources, general fund. Alright. So that was number 8. Number 9 says a cash payment of $15,000 was made for the purchase of equipment. So, the equipment on fund-based financial statements, expenditures, equipment, 15,000, cash, 15,000. Let's go on to number 10. Licenses were collected in the amount of $3,000. Still in the general fund. Number 10. And so we are going to receive $3,000. And it's going to be revenues, licenses, $3,000. Number 11 says the balance of taxes receivable became delinquent. Okay, so this is the amount of money we didn't collect in taxes. So it's going to be tax receivable, and we're going to create a delinquent receivable. And then we have allowance for uncollectible we're going to remove the allowance for current one, and then we're going to remove the taxes receivable current and create an allowance for uncollectible taxes. For delinquent amounts. So we had $200,000 in the tax receivable. We collected $150,000, and $2,000 is uncollectible. So our new amount that's delinquent is our $200,000 receivable originally minus the amount we already received. So $50,000. Our allowance is still going to be $2,000. And that is the journal entry to reclassify taxes as delinquent. To remove them from current to delinquent. And delinquent means we're not going to collect them and be able to pay current resources from it. And number 12 says delinquent account taxes of $30,000 were collected before the year end. The remaining net realizable value of the delinquent taxes is expected to be collected uniformly over the first 4 months of the fiscal next year. So number 12. Now we're going to collect the $30,000. So cash, $30,000. And then we would reduce the taxes receivable delinquent. And then the remaining amount would not be able to be revenues. So if it's going to be collected during the first 4 months, we now have delinquent minus, I'm going to make this journal entry match, so it should say 30,000. So we have 20,000 remaining, right? And we're going to subtract out our allowance. And then we're also going to divide this by 2 because half of this is going to be collected in the first 4 months. So the first 2 months, which is 60 days, so that's current, and the other half is not current, so that means we must defer the revenue. So deferred revenue so that means $9,000 moved from revenue and became deferred because we're going to collect that $9,000 in months 3 and 4 of the following fiscal year. And this is an example of journal entries for government inside a general fund. Chapter 11.